You've probably seen or interacted with Tripadvisor at some point in your life. You've seen that owl near a restaurant, near an attraction that you were looking for, something like that. But is it worthwhile as an investment? Well, hi there. Thanks for tuning in. My name is David, and today I'll be analyzing and valuing Tripadvisor. So let's start talking about the stock itself first, or the company actually. So they are three brands actually. They have Tripadvisor, Viator, and The Fork. TripAdvisor is what we know. It's an online travel guidance platform. You look it up if you want to see where there are attractions near you, if there are good restaurants that are rated near you, etc. Fighter is more of like a place where you book experiences, you book stays, you book hotels, etc. Then the Fork is a European online restaurant discovery and booking platform. So there I see reviews, I see recommended places, and I can make reservations there. So they have a lot of data, they have everything in the experience space. That's really what they're competing in, is the experience space. So they don't just only compete with companies like, for example, Expedia, but they compete in different places, like with OpenTable that does reservations as well, although that's more European focused with the Fork. So they have piece of multiple pies, which is good to know because in the case that maybe people aren't flying as much, well, maybe the attractions aren't as popular, but still they'll want to dine. So the Fork may be more popular than TripAdvisor for a certain moment. So now the revenue mix here has changed a lot over the years. I mean, TripAdvisor used to be most of their revenue. Now it's basically going to be at that 50% threshold. Viator is the big growth engine here where it's now 41% and it went from 7% originally. And then the fork went from a humble 3% to 8%. However, all of these are growing. In general, it's just that the relative share of TripAdvisor is closing compared to the other two segments. So, their strategy here, I mean, with TripAdvisor, they're focusing on engagement. So, they want to keep you in TripAdvisor. So, let's just say they want me to go in, they want me to review something, they want me to book something through them, etc. And there's multiple methods in which they can generate revenue from me, the client. So they want to keep you in TripAdvisor. With Viator, they want to invest in more awareness about the product and enhance the product there and make people come back to book again and again. Same with the Fork, where they want to keep delivering value to both diners and restaurants, hopefully bring more restaurants into the mix, more diners into the mix, and that way it can just keep growing and growing. So the focuses are a little bit different. Where TripAdvisor and Viator want to keep you there, want to keep you coming back. The Fork is still growing mainly. And so in general, the revenue for TripAdvisor has been, I mean, it struggled a little bit in the last quarter of 2023 and the first quarter of 2024. There's a trend we've seen with a lot of companies that they say we struggled a little bit at the beginning of 2024 and then things got better. You can see this very clearly with the EBITDA as well. If you see all their different segments, I mean, TripAdvisor is the legacy business that's making a ton, Viator making a little bit less, but it's still pretty healthy here, even though the EBITDA goes negative sometimes. Same with the Fork, where it does make that revenue, it does grow, but the EBITDA is not always there. So you see that most of the actual profits still come from TripAdvisor, even though most of the growth comes from the other segments. Their quarterly free cash flow is also faltering a little bit, and their liquidity is pretty good. So I am someone as an investor who really likes looking at free cash flow numbers. When I see these negative numbers in a quarter, I have a few alarm bells go off. I want to find out why, and I also want to see how this rise happened too. And the liquidity position here is just good to know because TripAdvisor actually has very little to no debt. They have way more cash than they have debt. So that's great because you, as an investor, don't have to worry about the profits going all to paying the interest and debt, for example. So that's great because that's more that they can do with the profits. Now, the long term here, the long story is that they are a company that's still recovering from 2020 or just finished recovering there in terms of revenue. But in terms of profits, I mean, man, they've struggled. They've struggled to bring it back to the positive because at least before, even making less revenue, they used to make way more profits. And that's also something that concerns me a little bit. Now, If you see how do we calculate free cash flow? It's cash from operating activities minus capital expenditures. However, you have to subtract stock-based compensation as well because this is an expense at the end of the day, even though it gets added to cash from operating activities. So cash from operations here, I'm comparing these two values, and I'm just showing you that over time, look how stock-based compensation has grown, monster growth for stock-based compensation to the point that in 2021, stock-based compensation was more than the cash from operations. That actually means that they had negative free cash flow that year. And you have to be very wary every single time that stock-based compensation is growing. You have to account it in there because it actually means that they do have more expenses than they're showing. So, in light of this, I have to adjust my valuation model to make sure I'm accounting for this monster stock-based compensation that they have. And I'm going to do a discounted cash flow model here my variables here are going to be an 11% rate of return per year. So I'm saying it's growing by, I want it to grow by 11% per year or give me a return of 11% per year. That's 1% more per year than the market. It adds up to be quite a lot over time. I'm giving it a 2% perpetual growth rating. It's essentially it's going to grow by 2% forever. And in the year 2024 and 2025, I grabbed analyst estimates that were just kind of saying $180 million of free cash flow. Okay. And then from there on, I'm growing it by that 2%. Then I am going to just put that in a discounted cash flow model with my variables. It gives me a market cap near 2 billion. However, if we divided it by the total number of shares out right now, the fair value of equity would be $14.40 per share. However, if we add the cash that they have, that value goes up to $16.29 per share. Now let's compare it to where Tripadvisor is right now. So this is interesting because they're right now they're at $14.49. So they're a little bit below this number, pretty much on the money with the first number before adding back the net cash that they have. However, it's interesting because it's not that much less than this calculation I have here. If you want to put a margin of safety, if you want to be very conservative, it's probably fairly valued in that case. And if you see the journey of the stock here, I mean, it's crazy. It was valued at $60 at one point in 2021. That's crazy because they were making less revenue and less profits in that point. So you can tell that at this point, it had nothing to do with fundamentals. Now, at least, it's trading somewhere closer to what the estimated cash flow is. But before, I mean, this stock has gone crazy before for no particular reason. Even in 2024, earlier this year, I mean, it traded near 30, and I feel like that doesn't quite align with reality regarding their valuation, regarding their fundamentals. So now we're at this point where it may be a little more reasonable. However, you have to account for volatility. I mean, TripAdvisor has seen such a significant fall in share price, both from the post 2020 and since IPO. Volatility can be your best friend and enemy here. I mean, the tourism industry is a fickle one. That's one where in a global recession, I mean, people are going to stop traveling. That's the first thing they're going to do, you know? But if you can buy TripAdvisor when tourism is looking great, I mean, if they deliver surprises in the next 2 quarters, for example, I could see a movement like this $14 back to this 20 something level. So if you can recognize it, you could have a great short-term investment in your hands. In the long term, however, you may want to look at more profitable alternatives. I mean, they've been struggling to put out income there. And there may be other companies, I don't know, Trivago, Despegar, Expedia in some ways, Booking.com, but they're more consistently profitable. And the mix you want here is great profits and cash flow and a low valuation. TripAdvisor may have that lower valuation, but I don't know if it has that profitability and consistent growth in profits because it does have it in revenue. And that's what makes me wary of it being a great long-term investment, besides the fact that it doesn't give the shareholders much back at the moment. It doesn't give you profits that it may reinvest in the company. It doesn't really buy back that many shares, and it doesn't have a dividend of any sort. So it's not really giving anything back when other companies in the tourism sector may. So what's your time frame? I mean, that's going to determine whether or not you're interested in a lot of investments. As a long-term investor, you have to start caring a lot more about profits, about dividends, etc. If you don't care about that, then you probably have a shorter time frame. So before investing in something like TripAdvisor, ask yourself, what is my time frame and does this company make sense within my time frame given the fundamentals? Now, I hope this video was very informative. I really enjoyed analyzing this company. I think they're a very fun one. And with that said, thank you so much for watching. Like and subscribe if you want more like this, and have a great rest of your day.